We're at a generational high in terms of employment statistics for the US economy. So without a substantial output gap, or the economy not being below trend, as it were, it's difficult for the Federal Reserve to ease financial conditions too much, because if we go off to the races again, we're just going to have a resurgence of the inflation problem. So that's my key worry.
On WealthTrack, temper your optimism. Noted global value investor Matt McLennan on the very real risks facing the markets.
Funding provided by ClearBridge Investments, First Eagle Investments, Royce Investment Partners, Baird, Bill Miller, Research Affiliates, Strategas Asset Management, Women Investing in Security and Education, and Matthews Asia.
Hello and welcome to this edition of WealthTrack. I'm Consuelo Mack. As the saying goes, markets climb a wall of worry. But when does the altitude become unsustainable, and how do you protect yourself from inevitable declines? Well, there is a litany of worries that the stock markets climbed in fits and starts in 2023. 2 wars, one ongoing in Ukraine, a new one in the Middle East, increasing geopolitical friction globally, inflation at multi-year highs, interest rates driven to their highest levels in more than 2 decades, and fears of recession. The antidotes to these worries were powerful. Extraordinary amounts of fiscal and monetary stimulus still in the global financial system. A surge of interest in the vast possibilities for artificial intelligence and its potential beneficiaries, largely centered on the so-called Magnificent Seven growth tech stocks, which pushed the entire market higher. And investor optimism that the Federal Reserve has engineered a soft landing in the economy and that multiple interest rate cuts are in our future. As the fictional Alfred E. Neuman of Mad Magazine fame used to say, "What? Me worry?" Well, this week's guest is a worrier and a warrior on behalf of his clients. He is Matthew McLennan, co-head of the global value team at First Eagle Investments, where he oversees nearly $90 billion in assets, including several mutual funds. He is also co-portfolio manager of the flagship First Eagle Global Fund, which he started managing in 2008. It has a 5-star rating from Morningstar with both silver and bronze analyst ratings. First Eagle is a sponsor of WealthTrack. McLennan's track record speaks for itself. I asked McLennan to take us through his world of worry. What's at the top of his list?
So the market clearly had a great 2023 as core inflation came down. Equity earnings multiples went up, and there was continued confidence around the trajectory of the economy. And it has a lot of market participants enthused about the prospects of a soft landing and a continued bull market. But I do think when you take a step back from the price action of 2023 and realize that the rear vision mirror could look very different from the future, you have to think about where the market could be complacent. It's clear to me that the market's already pricing a soft landing. Earnings multiples are quite high. The S&P trades above 20 times earnings. Risk perception is quite low. Trading breadth on the New York Stock Exchange is well above average. So most stocks are above their 200-day moving averages. Consensus forecasts are calling for double-digit earnings growth for the S&P 500. So what could go wrong? The problem is we're priced for a soft landing, but there's been no landing. If you just look at a very simple metric, which is the level of total payrolls in the economy, divided by the total population, we're at a generational high in terms of employment statistics for the US economy. So without a substantial output gap, or the economy not being below trend, as it were, it's difficult for the Federal Reserve to ease financial conditions too much, because if we go off to the races again, we're just going to have a resurgence of the inflation problem. So that's my key worry, no landing.
Okay.
And then the second concern that I have, Consuelo, is that the fiscal situation is quite poor at the peak of the cycle. We had last year a budget deficit in excess of 6% of GDP. Now, usually when you have tight labor markets and a healthy economy, you see very small budget deficits. In fact, in the late 1990s, we saw a budget surplus, not a deficit. And so the fact that we have a 6% plus budget deficit at what had been low interest rates and are now being rolled to higher interest rates for the government's debt is a real structural issue. And that puts policymakers in a tricky situation, because going forward, they have to choose between tightening fiscal policy, which could tip the scale towards recession, or leaving it open in an election year and starting to get to a position where bond market participants fret about the fiscal situation becoming intractable. And when that happens, you risk more structural stagflation, more akin to what we saw in the 1970s. And so the fiscal situation at some point needs to be addressed. And if it's not addressed, risk perception could go up. And I don't think that that's being appropriately priced by markets right now. In fact, if anything, markets see the economy as resilient.
So we're talking about a 6% budget deficit, which for people who aren't economists, that doesn't sound that high. But in fact, it is, as you just said, in the current situation. And then we're adding to that, so the financing needs of the budget deficit, right?
Well, at the same time that we've had these burgeoning structural deficits, we've actually had a change in the composition of who's buying the treasuries that are being issued. If you go back a few years ago, it was many foreign countries like China, for example, that were net accumulators of treasuries for their foreign currency reserves. Since the time that we imposed sanctions on the Russians' ability to access their treasury reserves, there's been a little bit more reluctance on the part of foreign reserve accumulators, understandably, to acquire treasuries. And so that source of demand is moderating. Secondly, the Federal Reserve itself was acquiring treasuries through QE, but it's now running off its balance sheet. And then thirdly, you had the regional banks looking for a little spread, extending maturity and buying treasuries, but they now own too much and they have capital losses that are unrealized on those securities. And so the treasury market, as it's facing this wall of supply, needs to find new buyers. And the treasury yield will have to clear at a level that attracts hedge funds, mutual funds, other sources of interest in the treasury market. And I think the extreme level of volatility that we've seen in interest rates is part of that market clearing mechanism. But if you stand back from the recent rally and the sell-off before that, what's clear when you look at a 40-year chart of interest rates is that interest rates in the US have broken out on the upside from a very long-term downtrend as the market's starting to price that supply versus the change in demand character for treasuries.
How dangerous, how quickly could we see the markets react to these fundamental issues?
Well, often nothing seems to happen for a very long-term period of time.
Right.
And then a lot of change gets telescoped into a very short-term window. And we got a sense for that in the UK a couple of summers ago with the Liz Truss crisis. And so I think it's very difficult to predict these things. The future is uncertain, but I think it takes a perceptual threshold to be crossed where the market loses confidence in the sustainability of finances. And if that happens, then the pricing adjustment can be rather quick and disruptive. Now, we hope that doesn't happen, but that's usually the way it plays out. One thing I will sort of point out in terms of the structure of sovereign crises when they do play out is that in a healthy sovereign market, when interest rates go up, the currency tends to strengthen. But in an unhealthy sovereign backdrop, often you get interest rates going up because risk perception is going up, and therefore the currency weakens. And I think that's the risk that we're skirting with at the moment if we continue the current policy backdrop.
I'm talking to you about these the macro backdrop that is of concern to you as well. You are a bottom-up, stock-by-stock investor. Why are you paying more attention to the macro backdrop, or are you? Or is this just something that you've always done, but it's just been highlighted because of the heightened risks?
Well, you're right that we are primarily business buyers, long-term investors in the stock market. And our sense of true north is incredibly clear. We're all about resilient wealth creation at First Eagle. And the core of that for us is buying businesses that have some kind of incumbency advantage in industry niches that are available at the right price. And that is the core of our portfolio. But if you're a business owner, you have to pay attention to the potential for disequilibrium in the broader economy. And when you look at our portfolio as a whole, the way we address the concerns that we've been talking about is that we diversify, not just across industries, but geographically. So the MSCI World, the index for stocks, is quite concentrated. About 70% of that index is in US stocks alone, whereas our portfolio tends to be split more 50-50 between US stocks and international stocks because we value diversification. And certainly with the kind of risks of a complacent market that we've been discussing in the US being front and center for us, we feel that we're being compensated to diversify at this point in time. The second thing is that we don't put all of our eggs in one basket. Around 70 to 75% of our portfolio is in businesses that we want to own for the next decade. But we have about 15% of the portfolio in gold and gold miners as a potential hedge. And so the way we deal with these kinds of concerns is through the nature of the businesses we buy, our propensity to diversify, and then our willingness to hold a potential hedge in something like gold.
When you said about 15% now of gold, so is that higher than it's traditionally been?
It is a little higher than the historical long-term average. It's at a level that represents our sense that there are risks out there, be they fiscal risks in the United States, and by the way, there's fiscal risks outside the United States as well.
Right.
Be they the perception of geopolitical risk, which I think we'd all agree is quite elevated right now, or be it the fact that there's a sense that the market itself is rather complacent, particularly the growth subsegment of the universe. And what I can say is that we want an asset that can do well if expectations become more modest going forward. And in fact, if you look at the history of gold over the last 100 years, it's tended to have its best decades when equities have had their worst decades. So if you're primarily an owner of business through the stock market, it does serve the role of a potentially useful hedge. And I think as we've gone through this period where we've had a change in the structure of the treasury market, who owns it, the supply character, et cetera, as we discussed earlier, gold has really performed well relative to the alternative of keeping your potential hedge in long-dated treasuries. In fact, over the last few years, owning gold has roughly doubled in value relative to owning a portfolio of long-dated treasuries if you bought an ETF, for example, of 20-year plus treasuries.
So I just picked up on what you said, that that traditionally gold has done extremely well in decades where equities have not done well. Are you saying basically that your expectations for equities in the next decade are modest, if that's the correct word, or actually that they might really be bad?
Well, first of all, the fact that we have some gold in the portfolio and some equities is an expression of humility. If we knew exactly what was going to happen, we'd either have all gold or all equities. So
right.
The first thing to notice is that we have it there as a potential hedge, not because we have a window into the future that lets us know exactly what's going to happen. But in answer to your question, I think it's a little nuanced. I have quite modest expectations for the growthiest subsegments of the U.S. equity market in particular. If we look at the ratio of the value of growth stocks to value stocks in
right.
the U.S. market in particular, it's quite stretched relative to history.
Those excess valuations can last for a long time. They can last for years. And also, what about the artificial intelligence boost that we've seen, in the Magnificent Seven stocks, for instance?
When it comes to AI, we're a great believer that the key beneficiaries of AI will be company-specific applications or users of AI. There's a lot of talk about it as a sort of broad construct, and it's also the case that there are a range of companies that will benefit from AI that aren't priced at excessive valuation levels. And so the key is to try and be selective in terms of your approach.
So can you give me some examples, Matt, of companies that you think are beneficiaries that are not selling at these elevated levels that you have in your First Eagle Global portfolio?
So I'll give you just a few examples, and hopefully this will illustrate the point. So our largest two holdings in the portfolio have been Meta and Oracle. Now, these companies have done well over the last year. They have had some valuation expansion. So they're certainly not at the kind of discounted levels where we deployed capital initially into these businesses. But they're also at still quite reasonable valuations relative to the underlying development in their business. Both of these companies are beneficiaries of AI. Oracle, as the leading relational database company, as a partner to NVIDIA in the cloud, and has a very strong capability in AI. In fact, their leading database has run on AI. It's an autonomous database for a handful of years already. In the case of Meta, they've been investing heavily in AI for some years now. In fact, it was accelerated when Apple changed the protocols of their operating system and made it harder for Meta to collect data. So Meta needed to use AI to better profile its customers and ad positioning. And so these two companies are already heavily invested in AI and have the capacity to grow their cash flow at a double-digit rate over the long term. Now, there'll be cyclical ebbs and flows, but those companies are reasonably valued in light of that potential growth. And then it goes all the way through to companies that use AI in their business processes. So our largest Japanese company is a company called Fanuc, which is the world leader in CNCs and robots for factory automation. They've been long invested in studying AI. In fact, the grandson of the founder, who's a very important member of the management team, studied artificial intelligence at Berkeley, did his PhD in that field. And they use AI for predictive maintenance of their robots in the field. And so I think AI is already diffused in different corners of the world, whether it's databases, whether it's social media, whether it's robotics. And the simple insight I would share with you, Consuelo, is that you don't have to buy a concept stock at 40 times earnings or 50 times earnings to be a beneficiary of AI in the economy.
Where are some of the other areas that you're seeing really good, high-quality companies selling at discounts?
You can imagine in an environment like 2023, when people really wanted to jump on the growth train in the United States, that perhaps the value was outside of the United States in areas that had more apparent mundanity. And to give you an example of that, there's a company that we own. In fact, it's our largest investment in Brazil, called Ambev. And this is the leading beer maker in Latin America. In fact, they have over 2/3 of the market for 80% of their operating income. So they have businesses not just in Brazil, but throughout all throughout Latin America and the Caribbean, and even in Canada. Very strong market share position. Some of their core brands have been around for over a century, and the business is growing. And you have no debt, you have net cash, you have a 6% dividend yield, and a valuation is very sensible. And so, if you're willing to buy something that's seen as a little more stodgy in this environment, then I think something like an Ambev, because of its emerging market taint, if you will, is quite reasonably valued. Yet the beer business is a very stable business and very cash flow generative. And so it's looking in areas like that where we've found opportunities more broadly in the consumer staples arena. And I think investors forget that there are two reasons why you can get a valuation premium in the stock market. One is the perception of growth, and that's being well priced right now. But the other is for businesses that have unusual resilience. They usually trade at premiums. You'll recall back in the late 1990s, companies like Coca-Cola traded at huge valuations. Right now, there are many staples with century-long brands that trade at a discount to the market, and Ambev is one of them. Another example of where we might see value in the markets would be in those economies that have been subject to the greatest negative sentiment. So the US, we've been talking about, has been the subject of very positive sentiment. You can imagine what the polar opposite of that is China, for example.
China. Mm-hmm.
So the S&P trades at over 20 times earnings. The Chinese equity market trades below 10 times its trailing peak level of earnings. And so there's a very big valuation gap as investors have weighed the risk of the real estate markets there, policy, geopolitical, all of that. Sometimes the macro taint can provide bottom-up opportunities. And one particular situation that we've found interesting is a company that actually happens to be listed in the Netherlands. It's a Dutch-listed holding company, and from following us for many years that we find value in holding companies often because you get a double discount if they own stock in a cheap company that's undervalued, and the holding company trades at a discount. It's a double discount. Well, Prosus is an example of that, where they own 27% of Tencent, the Hong Kong-listed Chinese company. Now, Tencent is an amazing business. They are sort of the online leading business in China. They have the best social media and payments platform. They have the best gaming platform. They also have the best online advertising platform. And so this is a very embedded company in the Chinese internet that's very cash flow generative. They also have a portfolio of investments in other companies. When we strip out the value of that portfolio of investments, Tencent trades at less than 10 times EBITDA with a very strong balance sheet, and they're buying back stock. But Prosus, which is the holding company that owns this 27% stake, trades at a discount to the value of its Tencent holdings, and it has another 25% of its intrinsic value in other non-Tencent holdings, which are largely online businesses in Eastern Europe, Brazil, India, that are leaders in their niches. And so there are situations like this where you get the holding company discount and the discount of the ultimate end security because of negative sentiment around a particular country.
Matt, one investment for a long-term diversified portfolio?
Well, maybe I just gave it to you. I think Prosus is an interesting one, and I would just add that even though we find it a very interesting investment, and it's our largest Dutch listed holding, and it's our largest indirect exposure to China, it still represents less than 1% of our portfolio. And here it is the lesson that in a world that's uncertain, you have to be willing to invest in a range of different business opportunities at reasonable prices. We don't tend to get too carried away with any one investment, and that's been part of the reason we've been provided an element of resilience over the long term.
I have to ask you about one last stock that is one of your top 10, but again, I think it's a little over 2% of your portfolio, and that's ExxonMobil.
So Exxon is a company that we've now owned for a few years, and at the end of the day, the way we think about Exxon is that it's an essential infrastructure company. That basically they have some of the greatest energy basins in the world that have the longest duration and that are the most cost effective. And if you look at their upstream business, it's not just oil, it's oil and natural gas. Natural gas has been an important transition element. It's much lower hydrocarbon intensity. But the simple observation we made with Exxon is that, yes, we're going through an energy transition, but it's going to take longer than most people expect.
And Matt, I have one more question to ask you. Do you remain optimistic that there are and will continue to be companies that can thrive, kind of no matter what what macroeconomic problems are thrown at them?
So sometimes companies sell products that are more necessary than governments, in a sense. Companies have endured over many cycles internationally, and I think the key is, often in environments like this that are quite stretched, where a certain small number of growth stocks have done very well, or the global political risks seem to be extreme, it's tempting to throw in the towel. But I'm reminded of the words of one of my favorite poets, Tennyson, who my daughter is named after, ironically, at the end of Ulysses, where he says, to strive, to seek, to find, and not to yield. And I think the important thing as an investor is to stick to a discipline, to seek out opportunities within that discipline, and you'll ultimately find them if you've got a global universe. But importantly, it's not to yield. It's not to try and give up because the risks seem too much, or to give up because other sectors seem to be hotter. I think there's a certain wisdom to sticking to a philosophy, grinding it out over time, as I say, as opposed to trying to max out in any one environment or be totally out of the markets. I think if you own good businesses that sell relevant products at rational prices, it's a good place to be long term.
Good place to end this interview. Thank you so much, Matt McLennan, for joining us on Wealth Track.
Thank you so much, Consuelo.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is add some buffers to your portfolio. As we just discussed with Matt McLennan, his First Eagle Global Fund is unusual in its long-standing holdings of gold to steady the portfolio in rocky markets. He calls it ballast. Other managers we've interviewed over the years, like Fairhome Fund's Bruce Berkowitz, call cash and its equivalents financial Valium to stabilize his portfolio and himself in challenging times. Others, like now retired FPA New Income Fund manager Tom Atterbury, added short-term high-quality corporate bonds and commercial paper to prevent portfolio losses. Whatever your preference, having a constant buffer position will help prevent the permanent impairment of capital that First Eagle is dedicated to avoid, and also help you sleep better at night. Next week, Morningstar's personal finance guru Christine Benz will explain what higher yields mean for your retirement planning. It turns out they can have a significant impact, mostly for the better. In this week's extra feature, voracious reader Matt McLennan recommends an influential circa 1900 geographer's essay that resonates today. Please follow us on Facebook and our YouTube channel. Thank you for carving out time for us. Have a lovely weekend and make the week ahead a healthy, profitable, and productive one.